Good morning, guys. We are back. Yeah, it's been a long weekend. Recently took a little bit of a dive into a lost decade economy. Are you in the same camp that we will see these same patterns play out? Mm, I think there's some similarities, but I would say that the macroeconomic environment is significantly. I assume you're talking about like 2000 through 2012. I don't think it'll be the same as that. We were in a much better position fiscally to uh, redirect government spending and bail out the economy than we are now, especially so soon after COVID. Um, I would say that the fallout of a U.S. debt downgrade would probably, especially a significant one, would probably be more akin to kind of like the middle to latter half of the Great Depression. I don't think we're in such a bad position that we would, end up in the initial phases of the Great Depression, but there's and there's a lot more liquidity in the system and safeguards and stuff than there were back then. But the part where everything kind of had to reset from a wealth standpoint, yeah, I could see that happening again. Like, I mean, a big part of what drove the wealth destruction and the Great Depression was that the market just didn't recover. So everyone piled back into the market after it crashed. It crashed again. They piled back into the market again. It crashed again. Right, and that continuous factor um, caused a significant amount of wealth destruction. But I mean, in the long run, that's probably a good thing, right? Don't underestimate the government's ability to keep this shit show going. Ew, this chat has rules and guidelines. No, I'd accept it even though I don't actually accept it just to write this. Whenever Girk's not speculating out Carvana, all of the other Pickle Jar characters should be asking when Carvana. I was digging into it a little bit more. There's some interesting connections with Drive Time and the CEO. I mean, they're all like family businesses. But currently, the way I see it is that Carvana's positive cash flows are supported by payment in kind on their debt. Um, and being allowed payment in kind up until quarter one of 2025 is boosting those cash flows. Now they've issued some shares, like 3 million shares, to pay down about 250 million in their 2025 notes, but they still have um, I mean, an extremely significant debt burden, and the payment in kind on that debt starts to roll off next year. And as that payment in kind rolls off, their cash interest payments are going to increase. I think to about 5.7 million by the end of next year. Um, and so the cash flows that have been supported by not only their equity in Root, which has improved in price significantly, but also by their payment in kind will no longer be there. It will dissipate. Um, and, if you look at the rest of the sector and their competition, their forward PE should probably be somewhere closer to, you know, actually, I don't want to say that yet because I need to do more math on that. But their multiples are going to pull down as their cash flows fall off. I would say their valuation rough estimate right now. They have a ton of shit to dig through. Um, but I would say that like a rough valuation would be somewhere around like $20 to $28. I'm gonna probably trim that down over the next week as I continue to dig through all of their tranches and shit. But yeah, it doesn't look good. Yeah, no problem, magnanimous. Am I looking at Dominion Energy? Yeah, we could take a look at it. Sitting above GM, I wonder if it's an opportunity to sell bear calls for November 15. However, earnings are coming up. Interesting. So there are some risks with energy right now, especially in, selling covered calls. Generally, the returns on covered calls aren't worth the risk of assignment. On most dividend stocks, you'll find that to be true. So unless you're extraordinarily sure of price action over a set period of time, it's usually much better to stay away from it. Let me take a look at their options data too. Yeah, sitting a bit over GM. I feel like that's more of a factor of lack of liquidity on the chain. There's a decent amount of OI near spot, but when you get outside of spot, like below 50 or above 65, there's almost no fucking call interest on it at all. Going into earnings, it does look like there's upside call interest at 62, 60, 62, 50, and 65. So a surprise beat on earnings would probably take it up to that 65 level, regardless of Gamma Max. Realized Vol's been picking up, but Ivy isn't falling off yet. At least not on the 30-day contracts. Ivy's still picking up over 10 days. They go out to 60. It's starting to come down a little bit on like the 60 and 90. So there might be a little bit of short vol moving in, but I would probably wait till after earnings. And Gamma Max is more likely near 6250 than it is um at 57. Yeah, Gamma Max. I would say Gamma Max is actually a little higher than it appears, like 60 or 6250. What's the whole thing with Root? So Carvana owns 5% of Root through warrants exercisable at $9 a share. But Root is also a customer of Carvana. And or well, yeah, a partner, I guess. Carvana is a customer of Root, but they're a business partner, and so on every car sale Carvana makes, they have a pretty heavy logistics load tacked onto those sales, and their current gross profit per car is negative. So they're taking a net loss on every vehicle they sell. It used to be higher, around $3,000 to $5,000. Now it's around like $1,690 per unit that they sell. But in that loss, per unit sold, a significant chunk of that money goes to Root for insurance services. And so, as Carvana attempts to increase volume of sales and drive up their near term falsely positive cash flows, more and more money is getting pumped into Root, right? And the demand for used cars is going up because used car prices is dropping, or are dropping, and they're dropping at a pretty rapid rate. I think the Manheim used car index is down like 8.5% on the last report. So as more and more people buy more cars, Carvana loses more and more money because they lose money for every unit they sell. But then also Root makes more money. And since Carvana has not insignificant ownership in Root, they are incentivized to lose that money to them, right? And I think as this kind of Ponzi-esque scheme breaks down, Root will likely increase its fees towards Carvana, and Carvana will be more than happy to pay those increased fees as they burn out their inventory at a loss and shuffle off the profits to, Drive Time and Root and their other partners. Leaving behind a big pile of debt. So yeah, that's all the fun stuff. You think a retracement is due for silver and uranium? I mean, I'm pretty bullish on uranium, but I'm not trading it in the short term. Which one? You are NM? Um, yeah, I could see that pulling back a little bit. I'm not a big fan of uranium miners at all. I think moves in uranium miners are almost entirely speculative. Very few of them have production numbers to be significantly influenced by the spot price of uranium, and the amount of time it takes to spin up more production is significant. So I would say that a lot of the gains in uranium miners specifically are probably not sustainable, right? The amount of capex that's going to be required to increase uranium production is not a laughing matter, and most of those companies are not cash rich, right? And so you're probably talking about very broadly a lot of share issuance, especially at elevated prices. So uranium miners, I think, are still extremely risky. Silver, eh, what are you using? SILJ. You sure that's a ticker? Are you using that silver miners ETF? I don't even know if there are any like big legitimate silver miners. There's very little demand for silver. Um, it's a great conductor, but it tarnishes. Um, it's still trading at a discount to NAV, or premium. I'm sorry, premium to NAV. I don't particularly like this. Um, I think the gains aren't all that strong. It could probably fall back. Silver can squeeze on Comex, and that might drive some price action. And you could get a continuation. It looks like above like 1580 would be a breakout if you really want to try to confirm upside on this. But this is probably the last instrument I would use to trade silver. All of these moves in precious metals and industrial metals, you really want exposure to spot, not miners. Miners are lagging, they're not the same. Oh, they absolutely will use drive time and bridge crest. But their losses per car, not a lot of that outflow is going to either of those. A little bit to drive time, but it's not as significant as the amount of money going to Root. Hence why they bought ownership in Root. Part two question. Looking slightly forward, will the aging boomer workforce exiting cause ripples that will take out more small businesses, kids inheriting companies, and wealth they mismanage? I mean, yes. Also, you're presuming heirs, right, across an entire generation of people. And while yes, a significant portion of them do, like 80 or 78% of them have some living direct lineage. That's still 20% of that generation that does not, right? They don't have any children, or they don't have any living children. And so there's a lot of money that's just going to go into the void. I mean, if you think about the total assets owned by boomers, right? And you think about 20% of that money just poof gone, or to the state. Um, that's it's not an insignificant amount. And then yes, obviously, I think you'll run into a number of issues, not only tax burden, but you'll run into mismanagement of small businesses that are passed down. Um, you'll probably run into mismanagement of like income and rental properties. You'll run into disrepair. And then you have probate processes and stuff which slow all of that down a lot and can create even more financial burden on the inheriting party. So I mean, yes, the process of boomers dying off is not going to be pretty. Not to mention as they age and push into an age where they're no longer able to care for themselves, a lot of that money is going to go into healthcare. And I mean, like really long term, like 10, 15 years, I'm pretty bullish on, nursing care and things like that. Because, their children don't want to, take care of them, wipe their asses and tube feed them, right? And I know that's sounds terrible, but it's just kind of a matter of fact thing. And so, obviously rates are going to go up as demand goes up. And I think a lot of that money is going to get swallowed up by the healthcare sector long before anybody ever inherits any of it. Lose homes they can't pay taxes on. Yeah, especially as those homes continue to get appraised higher and higher. That's something we're running into right now that's already an issue, right? Is that people, who've locked in these really amazing low rates, are seeing massive increases in their property taxes because the market's continuously pushing the value of their home higher. That's unfortunate. And since so much of real estate appraisal is just based on comparables, I mean, a tax assessor really only has to look at, 4 or 5 other houses in the area and be like, that's what your house is worth, right? Thoughts on 14-day time horizon on CL, possible trying to retest 52-week lows in advance of US elections. Okay, so I have a buy order in at 70, as I should. But I am short below 68, 68, 65. If we fail 68, 65, I'll enter short. Probably look for a retest around 64. But didn't the Iranians just launch a missile at Netanyahu's house today? That's going to be escalatory, right? Probably intentionally so. I think the concerns around oil going into the election are to the upside, right? The SPR is at extremely low levels. We're kind of capped out on production unless we start to really push expansion in the Permian Basin or the other fucking one to the north of it. I always forget what it's called. But we haven't been doing that yet, right? Like we've been expanding a little, but um, not nearly as much as Buffett would like. Um, so I mean, I think we could bring costs down, but I could see us running into deficit issues and very little left in the SPR to control prices, right? Probably enough left for one good push before it becomes, problematic and speculators start to get extremely worried. BHP mines uranium, but it's only a fraction of their operations. That's true for most big miners that have like enough cash to expand. And Kazatomprom is just continuously cut production, and that's really all that matters, right? They control such a significant amount of the uranium market. Why do you think oil shorts are so stubborn, considering all of the obvious risk? I don't know if it's stubborn. Think they've been trying to get out recently, but very large positions. I mean, it was only a few weeks ago that we had like one of the largest oil short positions ever. I would say they're probably betting on a crash, right? A drop in economic activity, a significant drop in economic activity that would indicate a recession because oil will tank if that happens, right? Hedge or bet to the downside, either way, right? They're betting on the same outcome. And with the current economic uncertainty, I mean, it makes sense that there's a demand for an oil short. All we need is what one labor data print over the next 6 months to scare people, and that's enough to destroy the whole soft landing narrative. So I mean, if you're long equities, short bonds, yeah, um, you don't want to see that. ABPV ever gonna come down? Selling bear call spreads? I don't know. I haven't sold call spreads on it since the last time. It seemed pretty pinned to like the 190 level. Oh hey, look, it's sort of coming down. I wouldn't say that the consolidation on it's particularly bearish, but yeah, I mean it's starting to slump a little bit. It's not significantly influenced by its options chain. I mean, we found that out the last time we sold bear calls on it and had to wait like 3 weeks for them to print. Um, it can be pretty stubborn at these levels. I would say if it lost 180, things get a lot uglier, but anything above that's probably going to be pretty sustainable. And then any economic concerns tend to see like a bit of flight of safety into it, and it's fairly illiquid, so it tends to, the price tends to ramp up really fast. So I would say if you're gonna sell them, I would sell them far enough out of the money that there's very little risk on them, or just find a better instrument. Apple sold calls dangerous past earnings. I don't have any solds into earnings. I have some that expire before earnings, but yeah, I would say so. I mean, I don't expect a surprise out of Apple, but you never know. Also, they can announce share buybacks, which eliminate the need for a surprise in revenues or EPS. Like if Apple's just like, oh, we're gonna buy back 100 billion in stock, it doesn't matter what their fucking earnings are. And that I feel like that's always a significant risk, especially given how much cash they have on hand and how undesirable cash is right now. GME. Yeah, we can take a look at GME. Mm, we have ETF FTDs coming up in like a couple of weeks. It doesn't look like it's primed for any kind of OPEX move, if that's what you're wondering. A little bit of XRT covering on Friday. I guess the 4 hour. Feel a little bit more significant. Yeah, I don't think it looks particularly great, and it's still got like no arb. It's very, very liquid. You pretty much answered every single question except for mine earlier. Oh, how is build up to the election going to affect the indexes? Will we have a run up, then sell off, or opposite? I don't think anybody knows. That's why volatility is so high. And part of the reason vol is so high, I mean, there's a lot of factors. Geopolitical risk also being another one. But yeah, I mean, who the fuck knows? I'm sure we could look at historical examples, but I doubt they're actually applicable, and they'd just probably give us more bias. Could we expect vol to come down afterwards? Not necessarily. And if Trump gets elected, I could see volatility going up. If Kamala gets elected, I could see US debt maybe getting downgraded. Unless she has an economic policy that's different than the current administration, which is extremely unlikely. Things could cool off on a Democrat win for a few months, but would probably shift with the following, like the follow up QRA. Didn't the 2020 election go down like 6%, up 1% in a night? Yeah, it was pretty volatile, but I mean, how are you going to trade it? You play futures overnight? Yes, you could. The results are going to be contested no matter what. Yeah, but I mean, it's not like anything's going to come of that, right? Most likely. Is it me or does FSLR look interesting? I've been kind of ignoring it as rates go up. I could see it continuing to decline. The emergence of the European economy and the push into continued buying of solar by governments has been waning over the last 2 months. Europe's economy has not really recovered to the levels that I think a lot of people were hoping for. I will say FSLR doesn't have a ton of downside room left, but it could continue to just grind down and it could pick up more downside interest. Um, it's pretty significantly below like delta and gamma neutral, and fall below 200 here leaves the chain in a pretty bearish spot. I guess there's a little bit of support down at like 180. And then, I mean, it's mostly puts out to like 150 or 135. Can you go over how to read TTM squeeze again? So it has like two states. It's been a long time since I've used it. I have better tools now. But it's like upper Bollinger Band less than upper Keltner, and lower Bollinger Band greater than lower Keltner, right? So if the Bollinger Bands move inside the Keltner channel, right, and both of those statements become true, um, then this starts to signal squeeze, and so you start to get like on dots depending on how you have those set up. They can be red or green or whatever. And then after like six of those in a row, depending on your period, like the time frame you're looking at, the probability for a large volumetric move in one direction or the other starts to increase. And I mean, really, you're just using lagging data to measure consolidation, right? So it's looking at the past. It's telling you that price action has fallen into a very narrow range, um, and when price action does that very frequently, it'll break out, right? You'll get a large move in volume and a significant move in realized volatility. I think volatility is just a significantly better measure of all of that and can be tracked in real time. But if you really want to use uh, TTM, that's kind of how you use it. You're looking for those periods of tightening price action where both of those statements are true. How is drug gonna blast to 283? I don't know. I've just ignored it. Probably not. Looks like it's Nasdaq. Nasdaq bio shit. Looks like somebody bought some of their shares for 21.70 a share. Probably some shorts got squeezed out, but I would expect it to settle back around 21.70. This just looks like a short squeeze, right? Looks like it found a floor at 21.70 and then some more squeezed off. Don't forget, this is on NASDAQ where the DMM is automated, so it's very good at netting all of this shit out quickly. And the rug pull on these is fierce. Fubo? Yeah, we could check Fubo out. Fubo's been getting a little bit of covering. I mean, vol is moving up. Right? And that's going to put pressure. It already put pressure on the $1.50 calls. It's going to maybe put some pressure on the $2 calls, right? As volatility goes up in the near term, it increases the multiplier of Vega on longer dated contracts. So that's which adds you're adding more delta to those farther dated contracts as both the price increases and as vol goes up. So I mean, yeah, this is fairly standard prior to earnings lately. I mean, we tend to see a bit of a bit of pre-covering, largely because Fubo's had so many earnings beats, right? In recent memory. We may see it get shorted down directly before earnings again, because we've seen that the last couple of cycles as well. But as they continue to beat, over and over, I think this will be their seventh consecutive beat if they're able to upend analyst expectations, which are actually lower for quarter three. Then I think that would be pretty bullish. Atomics 150 cc's are in danger. We could still see below 150 before earnings. Like I just said, they've short, like back here, right? They shorted it right into earnings, pretty hard. Could zoom in more on that, but right, we got down pretty low the day before earnings, well below 150. And then post earnings, you see the volume where they pull them back, right? And we move up. So I wouldn't be surprised if we saw the same here. Could you explain how you like to manage iron condors when selling them for income? I mean, I don't I don't frequently sell condors. Not really, right? They're short strangles. Where I'm, sometimes hedging off one side or the other if I think there's a risk of like, a 1 or 2 sigma move. But for the most part, I mean, like 30 DTE, 15 to 30 DTE, rolling positions sold. I don't use standard deviations, but you could, I guess like 1.25 to 2 standard deviations out of the money. I usually have 60 to 120 open positions that are continuously rolling. So, every day, 1 to 2 to 3 contracts expires, and then I reposition those based on that day's price action. If the risk uh, for a larger than expected move increases, I'll have a hedge. If the risk for larger than expected moves is elevated, I'll have a hedge. That's a really simplistic way of breaking it down, but yeah, it's it's extremely capital intensive. Um, that's not a brag. It's just, it's low risk, low yield. And in order to make any decent money on it, you need to have a lot of capital, right? For your yield, like your gross income off them to be significant. We could kind of review like something I have open right now. I guess I was talking about this with some people in like the SPX chat the other night. I think I have it saved on here. Give me a second. Save this. Yeah, this one. Um, so this is like one position that's open right now. I might need to change the range. Let's say, there we go. So you can kind of see it a little bit better. So I was, selling puts on the way up. We've gotten up here near Gamma Max, and then like last week, on one of our like near Gamma Max tests, I picked up some November 5800 puts. So my profitability is fine, right? It's like locked in. So just selling puts against the trend as we move up, right? And that I can reduce. Hold on. Zero the target. I don't know why it's showing up like that. Hold on. There we go. So I'm already profitable. Like I'm not making really any more money to the upside here. And so I'm just kind of waiting for these like 1025 and 1031 puts that are down here to fall off. And as those, expire, I had more. I had OPEX ones that were slightly closer to the money. I had 725, 775 on OPEX. And this is just the put side. I have a call side also. But it's less robust. Um, so as those start to fall off, right, and the delta on them starts to decline, I'm picking up, 5800p for November OPEX. Not only to protect my gains that I've already locked in case we were to get, like a 2% or 3% surprise move to the downside, but also to prep myself for starting to sell the other way, right? So I'll be like long the put, short more calls as I think, we reach a top and the index maybe starts to turn around. So right now I have, some sold calls at like 930 that fall off this week. I have some 60/25s that fall off November OPEX. I'll probably continue to sell those as we stay in our current range. More likely the like 59.50 and up. Just continuing to sell above that monthly GM. And then, hopefully as my puts expire, I'll be able to trim back the short position. And then, the market reverses, the calls go in the money, I buy calls to hedge, right? Like, I'll just do the same thing, but the other way. The amount of knowledge you require to do that is insane for anyone not realizing. It's not that crazy. I mean, the returns are meh compared to the risk, right? But I'm just not really like, I know it looks like a lot of risk. It's like, oh my god, max loss 24 million, but it's really not. Like, I mean, we'd have to drop with the hedge I have in place, right? We'd have to fall below I think 5300 for me to eat a loss at all. And we'd have to do it fast enough, 5360. So we'd have to do it fast enough that I wasn't able to hedge with like futures or anything like that. So it's not as crazy as it looks. It's really boring. A review would be cool. Need money to make money. Yeah, it helps. Is this strategy learned over time, or is this more playing your overall index movements ideas with legging into short straddles? The latter. I mean, I'm usually like, selling with the trend, right? Um, Generally speaking, anytime I sell on the sell side, I'm usually just selling with wherever I think the trend is going because I'm trying to just pick up yields, right? Oh, I don't have a defined list of companies I'm looking at long term. Can you share more of the short strangle condor stuff and Pickles picks? Even one or two contracts is decent for many of us for a little bit of consistent income. I put condors and Pickles picks every once in a while. The market's been pretty volatile lately. And I'm not gonna put short strangles in Pickles picks ever, right? No one here is selling naked. At least not in size, so it's not something I'm concerned with. Um, I do put condors in there though when I think they're viable. You want me to do them on SPX? They're very easy to get blown up on. It's a lot of picking up pennies in front of the steamroller, and you've got to be good at dodging the steamroller. I think the positional management might be a little bit advanced. But individual equities and stuff, I put condors and stuff. I put a lot of butterflies in Pickles picks because downside risk on them tends to be very small. And if my upside targets are correct, which they frequently are, or downside targets are correct, then the profitability to risk is very, very favorable. That's why I do those so often. But I mean, it's the same idea, right? I mean, me putting a butterfly on uh like what was it, AVGO, right? That was a recent one where your downside risk is like $2, upside profitability is like $400. That is not any different than doing something like this. I think I mean they're both essentially income, right? Because the risk of loss is so minimized on the butterfly. So either you don't make money at all or you make a little bit of money. Yeah. SPX counter is maybe when VIX gets lower. Yeah, maybe. I could see it in like a stagnant market, but we haven't had a market where like, you know, our market's been, it's gone from like low vol, high realized vol to high vol, low realized vol, right? And like it just keeps going back and forth between those two. And none of those conditions are particularly favorable for like longer duration sell side. It's been hectic, like all the last like year and a half because the market moves up so fucking fast overnight. Using a standard straddle times 0.85 for your expected moves to the MM? No. But you can. I mean, it's close. That is close enough. I don't use that, but it's close enough. Could you look at PXT's fundamentals? Maybe. Ew. Mm, gross. Mm, okay. I assume this is something you've been researching. What's the drawdown in EPS from? Operating expenses haven't moved much. Did they acquire someone or something? net income's been falling pretty rapidly. Non-controlling minority interest. Taxes have been a bit of a hit. Total operating expenses have been fairly elevated the last 3 quarters. Fees picked up. Pricing cash flows have been declining. Yeah, what was the capital expenditures? Huge capital expenditures are pushing down on their earnings per share. I don't know what they are though. It's killing their margins. And that margin last quarter was 1.26%, which isn't great. If that's, I mean, there's probably some worry that's going to be a long-term trend. Looks like they have not a lot of correlation with crude pricing. Do you know their production numbers? Like how many millions of barrels? Hmm. That's an MSTR. I don't know how much MSTR's options chain matters in predicting its price, but I could take a look at it. Can you calculate PE, EPS versus shares? Where does the multiples come into play? From what? Scalability. I mean, corporations that have better scalability tend to command higher multiples. But I mean, multiples, I mean, your PE ratio is essentially like, you know, you're multiplying the amount of money that investors are willing to pay per share of earnings, right? So, you know, if something's trading at like a PE of 10, that means people are willing to spend, you know, $10 per share for $1 of realized earnings. And that's your multiplier, right? Does that make sense? So like net income minus dividends over average like currently outstanding shares would be, you know, your EPS. right? And then your PE is, stock price over EPS. Where's my degree now? Fucking Christ. I think they bought the rights to more fields. Okay, all right. So some spending. I mean, I don't think it looks terrible. Obviously their stock price has taken a pretty big hit. Um, if those fields yield as expected, and the value of their investment is realized, then yeah, we can see the price go up. But that may take a while. Actually, GoEV looks. I mean, from a technical liquidity perspective, GoEV looks a little bit bullish right now. It may go up. I mean, like CSP yields are still decent, but you have to be smart with them and take the profits when they make themselves available. Otherwise, you just end up owning this piece of shit stock. Where's my degree now? It's only one company. New skill. What's this for? For uranium enrichment. It'd be worth looking at the companies on the cusp of certification, possibly. Yeah. If you want to try to get ahead of the speculative market, then it could be worthwhile. All right, let me see what the quants are up to, or if they're even around. No, they're not. Huh. If they aren't around, I'll gladly pretend to be a dork for you. This is weird. I don't know what to do with this. Church time. Oh, there's JFresh. JFresh is here. What's up, dude? Yeah.
Deep in a massive differential equation
Oh,
because I want to prove. Well, I'm doing it for myself,
that sounds fun.
but I want to prove Bob Elliott wrong, explicitly and without debate because I'm sick of seeing his stupid posts about an income-driven expansion that's not fiscally driven. It doesn't make any sense.
So,
Anyway,
so
that's what I
wait,
was.
what's his argument is that GDP expansion is income driven, not fiscal.
Yeah, through the velocity, which is now lower than it was before COVID.
That can't be correct.
Right. But he is confidently incorrect and has been since March, and I'm over it.
Hold on, let me look up what he's
This
saying.
is this is knowable. Well, his example of why I'm wrong is in year one you have 100% income plus 10% borrowing. That equals 110 of spending, and in year two you have 100% income plus 10 borrowing is equal to 110 of spending. So the same rate of borrowing supports the same level of spending, but you need an even faster rate of borrowing to get growth. And my response, which he has been ignoring for like forever. Where's my fucking response? Oh, it's buried. I hate Twitter. I don't even know if he even saw it. I can't see any of this stuff. Uh, I don't know. My response was basically, this is wrong. In year two, you now have 110% or 110 income plus 10 borrowing, which is 120 of spending, because spending is revenue is wages. It's all the same,
Yeah.
right? So deficits accumulate. And I'm trying to just explicitly write that mechanic out so that it's no longer debatable.
I mean, how is he arguing that like but the increases in debt would already suggest that deficit spending is contributing more to GDP growth than private income or what, like business investment?
He shows basically his argument is that since like 21 or so, 2021, nominal GDP has increased by 5 to 6 trillion. But government deficits are only 2 trillion a year, so that's not enough to explain that 6 trillion increase.
Yeah.
So he's not accumulating the deficits in the economy.
Oh, so he's
He's
not
like,
he's not factoring the
so
deficit.
like in year one, the government spends in excess of $2 trillion, and then all that money circulates the economy in year one, and then in year two, it just completely stops circulating forever again.
Oh, okay. So, all right, interesting.
It's not really that interesting. It's just,
I'm just thinking about how you're gonna prove it. I
well, I
assume you're
have
going to
I
take.
have like 6 pages of differential equations I've been writing down, so it's gonna take a while,
All
and
right.
but it's fun. I enjoy it.
I can't think of any better use of your time.
No,
Yeah, actually. I know we have like stuff
uh,
to do in a business, but fuck that. Prove this asshole wrong.
right,
Yeah.
exactly. I was thinking the same thing. I'm like, man, that's a lot of effort I'm putting into something that's not gonna make me any money. But yeah. Anyway,
I mean,
so
you could probably like just analyze like the fiscal multiplier, right? And just like $1 of deficit spending generates more than $1 in NGDP, suggesting debt-driven growth, right?
I don't think it's not quite that simple. Here, the problem is the accounting methods are not quite sufficient to capture all these things. I
Yeah.
mean, for the reason that I'm just sitting here writing all this shit because it's really complicated.
Also lagged reporting.
Sure, yeah. I mean, the lags are a big part of it too, right? I mean, I think this is a key to understanding a lot of the macro that's going on now, is that there are lags between, for example, when the government spends money and when the government collects money, right? So you can say from, just from an accounting perspective, the net, if they had balanced the budget, uh, then their expenses and their income would be equal, and therefore there would be no net economic effect, right? But we know
Yeah.
that's not true, because that money is moving through the economy before it gets collected. And so that round trip is important, because it's the rate of flow of money, not the net balance of cash,
Yeah.
that determines the economic output. GDP is a rate. It's not a money value.
Yeah.
So if you're not doing the rate balances, you're gonna miss a lot of the mechanics of what contributes to the economy and what doesn't. And so you'll see all sorts of folks like, and this is not just isolated to Twitter. This is the Federal Reserve. This are economic academia. Everybody. I mean, they constantly get these things mixed up, and they come to these wrong conclusions about what does and what doesn't impact the economy, or even how they would impact them.
Hmm.
So But it's interesting because these equations are complex. There's a lot of interesting mechanics to dig into. So I'm kind of excited. But I'm gonna have to cut myself off eventually. I can't just. It's gonna take me weeks, and I can't. So it'll be fun.
You could probably do it with like something more simple, like just
Well, that's what I'm trying to do.
like
Is like
regression or something.
well, no, I no that's another problem too. Is I mean that's how we end up with shit like the Phillips curve
True.
is, which is funny because the Phillips curve doesn't even regress very well, so we don't even have regressions to explain that. It's actually just the worst kind of anything. It's a bad theory that doesn't match reality and isn't based on sound balance rate balances. Anyway, but I mean that's part of the game, right? I mean you have to write the whole thing and look at like the whole fucking mess, and then you start saying, how can I simplify this down? How can I isolate pieces? How can I think
So
about
when are
this?
you going to become a professor of economics?
I don't know. They don't. There's not enough rigor in that field. That would
Well,
drive me
there's
insane.
econometrics, which is, significantly more
But you,
math.
I could not imagine having fun trying to explain this to basically 1,000 Bob Elliots. It would, it would drive me insane because they just wouldn't understand. Or there's so much dogma in economics.
But think of your speaking fees.
Well, yeah, but they wouldn't want to hear it because I'm not telling them what they like to hear, which is that their theories are great and their analyses are sound and awesome.
You know
Well,
who else was hated for the things they
oh, hey,
said?
it's Dork.
Jesus.
Did you just say Jesus?
Yes. What's up, guys?
Oh,
What's
Jesus
up, man?
Christ. Hey, Dork. Anyway, that was great. Yeah, shut me up.
Honestly, like it's the funny thing about economics, right? Is it's all just an
Please say
imperfect art.
economics.
The funny thing about economics is that it's an imperfect art of trying to quantify human behavior, right? So, I mean, yeah, when we talk about something like calculating GDP, right, which is what it's like consumption, investment, government spending, and exports, and then less imports. It's like trying to figure out exactly what counts in what category, even like in that whole thing, and like whether or not it's a net, positive or negative, and the whole thing is it's wild. And I think that what modern day economists are trying to do, rather than simply assess the situation as it presently exists, is they're trying to extrapolate said
Yes.
present situation
That's
into like forward sort of results. But the reality
yeah.
is that like that's like, I mean, it's like predicting the weather, right? I mean, when we think about how weather predictions work, it's mostly looking at prior patterns, and consistencies between them, and there's high degrees of correlation between those patterns from the past. And now what we're doing is trying to use that same methodology to sort of predict what the economy is going to do in the future, and it just doesn't work that way.
I
People are
mean,
chaotic.
that's
You know
yeah,
what you're
that's
describing right now is AI.
I mean, I will say that's not just a problem with modern economics. That's just a problem with economics, is that it tends to fail to grasp the reality of the current situation in favor of trying to predict a future situation, which likely will never come to pass.
Right, I
But
guess,
that's a
yeah.
problem with
Or
stock analysis as
but,
well.
but hold on. This is what really pisses me off is that the entire field of economics is perfectly okay with never being able to actually test any of their theories.
Well, they don't need to because nothing they say ever happens.
That's what I'm saying. That's what I say. There's no rigor. They don't test any of their theories. They just
No.
assume
Well, how could you?
that they
I
work.
mean, you just get like,
It's all
And
made
then
up, right? Like, because it's all like, oh, if this happens, then this might happen,
yeah,
and then
and
immediately
yeah,
it's just gone to shit.
and then something else happens, and they say something like, "Oh well, inflation expectations of the consumers were too high, so now we'll add that in, and that explains it."
So here's where economics stops becoming a science. Okay, so economics as a science is purely limited to those experiments they do with like monkeys and food, right? Like that's pretty much as close as you're going to get to an economic science
I
is
mean,
those behavioral things.
that's more like sociology
Economics
and
is as
psychology.
much of a science
It
as
is.
chiropractics.
Well, no, economics is at its core a study of psychology, right?
Economics is not a science. Psychology is more of a science than
That's what I
economics
mean. But
because
like
they measure
economics,
things.
like microeconomics and stuff like that, I mean, that makes way more sense to me because if you think about it, right, if your microeconomics theory is sound, then your model should be able to be extrapolated to the greater population and hold. But
Yeah, but none of them do. And
yeah,
they don't care.
as a
They're fine with
study,
that.
it's basically just like the thing is you have to think about it like the carrot and the stick and like all these things, right? So then that's really just the basis of all of our behaviors is we're a bunch of monkeys running around picking up bananas and who has more bananas and what does that mean for our social structure and what are we striving to do with these bananas and ourselves? It's like it's not
Okay, so
more
but
complicated
speaking
than
of that,
that.
it's I get that, but there are mechanics involved here. I mean, you're just describing it as just like this psychological phenomenon, but there is a mechanical phenomenon to it or mechanical aspect to it, which is what should be balanced and understood. And I'm arguing that regardless of what the psychology is, they don't even get the mechanics right. The fundamental rate balances that should be knowable and writable, they don't even get all those right between all the different entities.
Well, just come up with an economic model, win your Nobel Prize, and fuck off.
That's what I'm trying to do. It's going to
Yeah.
take me like 3 weeks.
He's gotta get we gotta get him speaking arrangements first.
Oh man, Jay Fresh, if you do win the Nobel Prize from this, you're the only thing you're going to say in your acceptance speech is, "It took me 3 weeks to develop this. What are you guys doing?" And then you just walk off the stage.
No, I'm just going to say there is no Nobel Prize in economics, and then I'll leave, just walk away.
Thank you for the fake Nobel Prize.
And the real $1 million.
Yeah.
Right. Well, yeah.
I'll share it.
It's all
I'll
done.
share it with Bob Elliott. We'll take half and half.
Lord knows he needs it.
Okay.
If
Anyway,
he's long bonds, he
he's-
does.
he's a nice guy, but he drives me nuts with this theory and his confident incorrectness.
He definitely has a very strong opinion about the economic situation of the U.S., and he is pretty steadfast in the validity of it.
Do you guys also hate confidently incorrect people as much as I do?
Well,
Yeah.
it's Dunning-Kruger. It's annoying. Yeah.
Yeah, okay.
Yeah. It's just people being dumb.
Like if I have to choose a class of people I hate the most, it's them. It's
Well,
the
yeah, I mean-
confidently
Say,
incorrect. I
when
don't
I was
hate the
younger-
ignorant. Ignorance is
What-
fine, right?
When I was a young boy, unfortunately, I was very confidently incorrect. As many young boys and young men and young folks are.
I'm confidently
Um,
incorrect all the time.
Well, that's the key difference is as I've gotten older, there's still value in confidently arguing your theory because you want to, give it its best run for its money.
Yeah.
The primary difference now is that if I'm wrong, I'm fine with changing my mind and being like, oh shit, yeah,
Yeah.
you're right.
Yeah.
I forgot that piece. And it's like not a big deal anymore. Whereas when I was a younger kid, it was like, oh, somebody tried to accuse me of being wrong. I need to dig in. I need to fight harder. Instead of just stepping back and saying, well, wait a minute. Do they have a point?
Yeah.
And they're like,
No,
"Ah, shit."
I think we all
I
go
missed
through
something.
that evolution, but especially like once you gain like a certain level of influence, right? That influences and biases your own opinion of your opinion, right? So you got people like Bob Elliott with a fucking metric fuck ton of followers on Twitter. He's like, I have so many
Does he?
followers on Twitter. He does, and it's like,
Yeah.
I have so many followers on Twitter. That must mean I'm right. right?
Oh, holy
And because
shit. 156,000 followers.
yeah, he's got a bunch of followers, but like that doesn't really mean much. Like that's not like some sort of like end all be all that this person is in a position of authority intellectually because they have Twitter followers. That's not how it works. And I think that,
I mean,
you
that's
know,
now you're describing the problem with social media and it creating, platforms for people based on their the amount of interaction that person receives proves how intelligent and smart and correct they are.
yeah, all it proves is how entertaining they are to look at.
Yeah.
That's all you have is entertainment value with a follower base, right? That's purely what it's a metric of. So
Like I'm right all the time. I don't have any followers anywhere.
I'm just an idiot on
Well,
Twitter and I don't have a lot of followers.
wait, you don't have any followers? It's just us three today?
Yeah, pretty much. I mean, there's
Have
like
we
some
scared
people
everybody
hanging
away?
out, but not many. Yeah. I think it might have been
Anybody?
last week's conversation about gallium dildos that really did it in.
Could be.
Probably. I think you also started late. That was probably the bigger one. Actually, my theory, which again, if we want to have rigor, we should test it. My theory is that it wasn't the gallium dildos, it was the time that you started the stream. I think if you'd started the stream at the normal,
But I started on time perfectly today. There's less people here than there were. Actually, the second you got on the stream, 30 people left. Which that's a pretty high correlation.
That's a problem. Yeah.
Yeah.
You're gonna have to do something about that.
Maybe you're just too bearish. You guys make me too bearish, and then everybody gets bearish.
It's okay to be bearish, but like I don't know. I don't get why that's such a
thing.
a crazy thing, right? Like
because
we're just like
so if I wanted to like get followers, right? Like generate interest online and keep people here. You people just want stock picks. They want, is this going up or down? When's it going to happen? And how can I make money off it? And they don't really give a shit about the rest. Like we've found the, 300 fucking people who care about the minutia in the entire US, right? Or at least, well, of the like millions of people that have viewed this channel, we've found the 123 who want to sit here and listen to us mentally jerk each other off for 3 hours. Right?
yeah.
Like we have condensed this stream. But I mean, yeah, if we wanted a lot of people here, we just say stupid things that people want to hear, right? Like economy's great, SPX 6000. Why aren't you long TQQQ? This is such a great time to buy a house. And then we could have millions of followers.
Okay, so how many viewers just jumped in after you said that?
8. Actually.
Oh god.
No, I honestly I think our format two of these things has gotten a little better. It used to be just full masturbation, and now it's like I think we actually talk about some stuff that's fairly interesting.
I could not disagree more. It's gotten worse.
I think we've only just become more isolated and weird over time. At least I'm self-aware, but it's not. I mean, again, we spent like 45 minutes last week talking about the practicality of gallium dildos.
That's true. We spent that long on it. Fuck.
Yeah. It was a while.
Okay,
I asked a real question up there. Did you? Oh. Do you think the large ES... Sure, why not? Do you think that large ES options positions for Monday is worth keeping eyes on? Thanks. The 5,800 puts? Yeah. Probably. There's definitely a lot of people betting that the index is going to drop. Here's my problem with that as it stands. I don't think there's all that much gamma left. to like, well, all that much delta falling off on the OPEX expiry, first of all, because there's just not that much delta.
Yeah, I will say, since we're pivoting to the market now,
Always.
like the value of contracts that dropped off on this OPEX was like nothing.
Yeah, it was really small. It was actually smaller than like a couple weeks ago. Like the like end of month I feel like that like end of month week had a bigger drop in delta, even on SPXW than the AM expiry.
Like, I'll have to rerun the chart because I forgot to paste it to someone, but the drop on this OPEX on like both contract values and like delta values was so small it almost doesn't even look like an OPEX.
Yeah.
So yeah, everybody's still in. I don't think there's going to be any sort of like unclenching that occurs as people roll, because there's like nothing to roll. Everybody's still in.
I'm actually more interested in like the VX contract, because it appears that, you know, there's still quite a bit of long interest in long vol. And it seems to have sustained through the contract roll, which is, I mean, it's falling off. Like, I think Friday, like that forward yield expectation on volatility finally dropped negative. It did.
Well, here, Girk, I got a screenshot in the chat that it kind of explains why demand for vol has been elevated.
Oh yeah, go for it. I mean,
yeah, check out that chart.
There's a bunch of reasons besides the spread and yields, but yeah.
If you look at the high yield spread, it's like it fell off a cliff over the past little bit, and I mean, during this whole time that it's been going down, the demand for vol has remained up. So
yeah.
I don't know what the correlation is there, but there's definitely some activity happening in the bond market, especially since the Fed cut rates and then yields went right back to where they were before they cut rates.
Higher.
Yeah, you're right. They did go higher, huh?
Yeah, significantly. I had a great chart earlier that I posted in the SPX channel. Hold on, let me see if I can find it. It's yeah, here we go. The US home mortgage 30-year fixed national average per bank rate following the Fed cut.
Oh yeah, it went up, didn't it?
It went up a lot.
yeah, but that's to be expected, right? I mean, this is we discussed this like before the cut, that we were like, you know, it's going to tighten credit conditions when the Fed cuts rates because spreads are going to go down, and that means that risk appetite is also going to go down.
Yeah.
So like this is totally expected.
It is, and with the tightened spreads, right? Like the tightened currency spreads, and especially USD JPY, right? We're looking at an environment where the total yields available to banks on these loans has been significantly diminished. As that spread tightens, remember that the amount of money that they can make on the spread decreases, and that is going to increase rates because the risk is still elevated, right? But now they need to price forward that risk onto the consumer rather than being able to hide it in the currency spread.
Yeah, that's primarily what I'm kind of talking about. I was probably a little vague, but that's exactly kind of what I was hinting at.
I just want people to. I know what you were going for. I just want people to understand the reason behind that. Well, part of the reason behind that, at least, or
right.
at least
the effect of that. Put a little more simply, it's that the risk profile of the consumer has not changed, but the cash flow profile of lending to said consumers has changed.
Yes.
So yeah, that's kind of what that means. And it's not like it's gonna like this isn't. Actually, you know what, Girk? Fuck that, because we need viewers, all right? This is going to crush the consumer, okay? They are running out of steam. They're practically tapped out, bro.
It's really it's actually really fucking the real estate market, right? Because so everybody, we talked a couple weeks ago how like right when the Fed cut, Zillow listings just skyrocketed, and part of that was North Carolina and the Florida hurricane, right? But part of that was just every other region in the country saw a significant increase in the amount of homes available for sale, right? But fewer of those homes are selling because rates are going higher than they
Oh,
were
right, yeah.
prior to the Fed cut. And so what that's actually doing is it's leaving a lot of homes unsold on the market, right? Over like homes not sold and been listed for more than 30 days. Um, and as the number of those continues to increase, people are going to start competing with each other on price, and they're going to compete the price down. And this is something we've talked about for 2 years. But we are starting to see the beginnings of that occurring in the housing market, where people are going to regionally start to fight each other to get their homes sold at a lower price. And as more and more people do that, home prices start to come down, which means that if you're bundling mortgages together into these big asset backed collateralized positions, the aggregate value of those declines, and that has an extreme impact on markets, especially on JFresh's favorite metric, leverage.
Yeah, and I must say, real estate agents are probably in shambles right now because as soon as the Fed cut rates, they all went to all their clients that were looking to sell and were like, bro, now is the time. Get that shit on the market. You got new home buyers coming in. These cuts mean that they're getting free homes. Let's do this thing. And now that their homes are listed, the real estate agent's like, bro, look, okay, so it's not quite selling as fast as we expected, but if we just, take off another 10 grand. Yeah, I know, I know. Don't threaten to kill me now. Yeah, it's an absolute mess for real estate agents
Actually,
on the
around
sell
like
side.
2014, 2015, I was working on a project where we were doing some analysis of the like kind of the effect of real estate agents and pricing patterns on like residential real estate values. And real estate agents play almost as large a role in bringing prices down as they do in pushing them up, right? So as real estate agents kind of like in buyers markets, real estate agents have a habit of pricing houses down as quickly as they feasibly can in order to sell as many as possible, right? And in sellers markets, they chase the higher commission, and so they kind of band together to try to keep real estate prices up. And all of this happens in like little pockets all over the country, right? But the behavior is very predictable. And so yeah, they play a pretty big role in play a pretty big role in bringing housing prices down as well, right? So on the upswing in values, they chase the higher commission. On the downswing, they chase the sales volume.
So what you're basically telling me is that real estate agents are no better than stockbrokers.
Yeah, I mean they are. That's exactly what they are, right? They sell something that isn't theirs for a commission.
uh, yeah, and I'm mostly speaking anecdotally from my own experience when I say things like that, but like just seeing like how like my lender like was like timing out when to actually get my loan underwritten and all that stuff. They were both very like keenly tuned into the bond market. I don't know if they were understanding it correctly or the economics of rates, but they were looking at that stuff and they were making decisions and providing advice based on what happened in the bond market. I could clearly tell.
Yeah.
So so I mean, once the Fed cuts rates, right, they go into a completely different mode than they were just in, where rates were high. And every time someone said to them, "I want to sell my house," they probably said, "Let's hold off till the Fed cuts rates."
Yeah.
So that's kind of, now that the cut has happened, we're going to see, a huge imbalance in the housing market as people try to, in a weird way, which I don't necessarily think like is a reflection on the people, but it's a repositioning of the market.
Yeah, it is.
So it's interesting.
Here's one more chart that I thought we could talk about a little bit. This one's kind of fun. This is advanced real retail and food service sales.
What's
Can you
advanced
post it
real
in the
retail?
Can you post it in the chat so I don't have to go on your stream and watch Google Ads?
Yeah. I'm trying to get the ads to go away, but I can't seem to figure out a way to do that.
Dude, Google needs that revenue, bro.
I think like I might just like switch all of the memberships over to like Ko-Fi and then just like start a new channel that's not monetized by YouTube. Because I think
There
that
you
might be
go.
the only way to avoid it.
Well, plus then you won't get DMCA, right? Because you're not making money off the content.
Yeah, that's true.
I don't know if that's how it works, but it
I don't
could.
think that's how it works, but maybe that's how it works. I'm not sure.
So what's advanced real retail?
That is the projected sales of retail and food services.
Okay.
Quarter over quarter. Yeah, month over month. So I think you're looking at like a Redbook retail sales aggregate.
Oh, I see.
Where's all the growth?
That's what I was wondering. It looks like it happened all at once.
It's in productivity.
It looks like it happened from 2008 to 2020, and then right after 2020, and then it hasn't done shit since.
Well, you had
We're
that
growing,
huge
though.
stair step up, so that was something.
Well, I
It
think
was
the
transitory.
key here is real retail and food services. Those are sticky super core components, right?
Yep.
That's still like 4 or 5%. So there's been no growth there. Been no real growth in that area.
No, there hasn't.
That's your answer right there.
The lack of
not
growth
growing.
in that sector generally leads to like that sector starting to collapse, though. Because it's primarily small businesses. And so as oh, 1 second.
Is this the perfect time for me to talk about my butt?
Yes.
Cool. My butt. All right, that was fun.
There you go.
I like how I went to market right back to economics.
What's he doing?
I don't know. He's
What
picking up.
is he fixing something, or is he just walking away and like
He got a new cheap Chinese katana shipped to his house so he could walk around the mall with it.
Nice.
Yeah, and a new fedora, new trench coat.
Dude, I just went to the Ren Fair yesterday.
How was it?
I mean, it was a Ren Fair.
Did someone beat you up, put your head in the toilet, flush it, and then take all your lunch money?
No, the Ren Fair is full of all of those people who had that happen to them in high school.
Ah, right. There weren't those bullies like hanging out outside though, waiting for you to come back out.
No.
I guess it's not like high school then. Okay, that's cool. I went to a Ren
Yeah,
Fair
it's
when I was
pretty.
a kid. It was cool.
My son wanted me to do the, like hit the thing and try to hit the bell with the hammer.
Yeah.
Well, and I got it. You get 3 tries.
Did you blow your back out?
And no, But I thought I like pulled a muscle in my bicep, but I didn't. I got it on my third try, and I was so proud because there's like a bunch of dudes that are like bigger than me that didn't get it.
But they don't have your knowledge of physics.
I did have better form. That was the
Yeah.
key. I've done a lot of wood chopping, so I've got pretty good form on that. But
You should
yeah, I
film
was like
that.
super
And,
proud. I was like, do you now respect me more as a man, like to my family, because they wanted me to do it? And I was like, I don't want to do it because I'm probably not gonna hit the bell, and then you're gonna not respect me. And their response is like, yeah, it looks pretty easy though. I was like, what the hell? Anyway, so now I'm telling you all about it, and I want to hear about how strong and wonderful I am.
You're so strong and wonderful.
I think you did an amazing job. I'm
Thank
glad
you.
to know that both your mental fortitude and your physical prowess are on par.
I tried to do both, but yeah, no, I'm a fat piece of shit right now. I'm not in shape at all. But I carry a lot of stuff, like carry kids, groceries. I'm always carrying things, so I've got like pretty good upper body strength. I'm also carrying the fat on my body around every day, so yeah. Anyway, good. It's good strength training. Just get really fat.
I thought it was just all your pent up frustration with FinTwit, and you just let it all out into that hammer.
No, I didn't think about FinTwit at all yesterday.
Okay, but was the hammer game at least medieval themed?
I don't remember. Not enough that I mean, it was all like medieval.
Like
Like
strike his
everybody
thine
there,
hammer.
everybody there speaks in like a weird British accent, and somehow dollars are pounds, but the conversion rate is 1-to-1.
Good morrow, sir. Are you interested in my
That actually,
chainmail?
that actually bothered me the most was that everything was quoted in pounds, but it
Oh,
was just dollars. And I was like, this isn't right. This doesn't feel right. I don't like it. There should
just
be
call
an
it
exchange
quid.
rate. I'm not paying fees, exchanging my dollars for pounds to buy your shitty popcorn. What is it in dollars?
What you should have done is you should have shown up with like a giant bag of rice and been like, I will give you 1 pound of rice for this sword. It is a
Yeah.
highly exotic food from a faraway land.
Yeah. No, it was a fun little time.
That's
Did
cool.
some stuff, spent some cash, walked around.
Nice. Yeah, you contributed to the economy.
I did.
Thank you for doing your part, Jay Fresh.
Good job.
Again, more praise. You guys are great. Maybe that's why I spend all my time with you guys.
Maybe we know how to keep you here.
Because my
Exactly.
my family's all just like, do this, do that, do more, spend more, do more. And you guys are just like, dude, this is awesome. You're so awesome.
I don't know if that's more of a reflection of how disappointed we've been in life or just how awesome you are, though.
I think we just need to sit down with Jay Fresh's wife and figure out how to work him. That's really what this is telling me. Is there's a way to get more out of him, and we just don't understand it.
We got to go to the kids. They know more than the wife.
I hate you.
So options market, anything interesting?
Well,
I was gone all
Willie,
last
so
week.
there's a big ES 5800 position, and Willie noted that it doubled. It doubled on Friday. It came in on Thursday and doubled on Friday. It's at 5800 put. It's quite large. I think at the last tally, it was looks like 26,500 contracts.
It expires tomorrow.
50 days.
Oh, 50 days. Okay.
Okay, are we going to be able to see the delta? Are we going to be able to see the delta hedge on that in the CFTC?
Oh, 2 days. No, 2 day
whatever.
2 day expiry. So it is tomorrow.
That's so strange. Yeah, it's got to be hedging some really short-term massive thing.
Or there's just everyone thinks the market's gonna dump back. I mean, it looks like a mean reversion play to me. Like everyone's just expecting futures to dump back to 5,800 because that's where all the CTA support is.
Maybe.
I could maybe see that, but like again, no delta fell off on this OPEX, so like I don't love the downside move here. But maybe that's the
Yeah.
answer. Is just there's no delta, so what's it gonna do but fall? I know a bunch of the in the money, like the in the money gamma that was supportive into the end of last week expired on Friday. So gamma might have fallen off harder than delta actually. So maybe there's support was already pretty weak. You know, bulls have been taking profits a lot lately, which is really annoying when you want to bet on them going long as fuck into the end of the day, and they're just like, no, we're good here, and we're gonna close up shop. But that's been a fairly frequent occurrence over the last few weeks, actually, where we kind of get to the high of the day pretty early, and then bulls just take profits for the rest of the day, and not a lot happens.
Oh shit! I'm just looking at SPSW. I'm trying to look at the gamma. Mm-hmm.
Hey, Girk is the same as
a fair amount of
I
gamma.
do.
A fair amount of gamma fell off. You're right. But it was still super elevated going in. So it's just back to like historical levels. I mean, maybe it's a little light, but it's back to the levels it was at in, all through September, October.
And it fell back from 20 billion to what? 8.6.
What are you looking at?
SPX.
Oh, I'm doing both SPX plus SPSW. It looks like it goes from 280 billion to 200 billion. Maybe most of that was SPXW. Let me look at just SPX. Okay. Yeah, that one's 160 billion to 90 billion ish. Delta's still rock hard everywhere.
Why are these values great? Okay. Are those aggregated right?
Where are you looking?
I was just looking at SPX and SPXW. So this is 27. SPX is showing me it's got 8.6. SPXW 19.01.
Oh, are you looking?
27 billion. What are you
Sorry,
looking at?
I'm looking at skew adjusted. I'm an idiot. Yeah. No, I got you. You're right. Gamma. Yeah, gamma kind of hasn't really fallen off though for both.
No, gamma stayed pretty. Actually, gamma picked up slightly on SPXW on Friday. But delta, some delta fell off, like a decent amount of delta, 40 billion, and then SPX had a little bit of delta fall off too, but it wasn't like what you'd expect from an OPEX. I mean, it was 2 point.
Yeah,
so
it was tiny,
like less than 400 billion.
Yeah, because just combined from between SPX and SPXW, you're talking at like $3.3 trillion.
Yeah.
In delta, and so we went from that to 2.9. So
I mean,
like $400 billion dropping off is like nothing for this.
GM is frighteningly close to, or GN is frighteningly close to spot right now. it's stayed there. You know, we haven't really had like a big lift off of like the neutral position in a while. I feel like it's not been since we turned around like back in even back then we really didn't get a lot of clearance on gamma neutral. It's been a while since we've had like the strong bullish pushes up into gamma max. And right now like we're a little bit above GN, but it's getting awfully close to the money.
Yeah, and I mean, what this is telling us is that leverage is pulling back on the call side, which I think everybody has kind of noted that. Guy I like to follow, Chris Sidialis on X,
Mm.
also confirmed this. Something that I had seen, which is that call leverage is pulling back. That he also observed the same thing, that people don't seem to be going out of the money as much. So people are picking up on that signal in the market. Professional traders are acknowledging that this is occurring.
Yeah, no one wants to
Um,
buy any more calls. Yeah, that's
yeah, and
really
so because
obvious.
everybody's all in on the calls they have.
Yeah.
And um, so as a consequence of that, right, your upside gamma comes down, so that max peak starts to shift towards gamma neutral. And then in the absence of any positive gamma from calls, like the puts totally, at the money and in the money puts totally swamp the gamma from out of the money calls, then those two things would touch. So that's kind of like a barometer. The distance between the two can tell you sort of, well, obviously can tell you what your range is. And
Mm.
so now we're kind of like compressing this range. Um, but there's a whole ton of downside potential. I mean, that's what I've been saying for a few weeks now. Like, I just don't really see much upside left in this, even like in the best case. Just from a macroeconomic perspective, I mean, consumers would have to, or households would have to allocate more to stocks and real estate versus cash than they ever have ever in the history of the country, for us to go meaningfully higher than where we are now. So yeah, all these things are kind of consistent with people being balls to the wall long, and
Yeah.
signs that people are starting to run out of fresh cash to just dump in.
For me, it's looked like there's been a lot of profit taking in tech recently. And while some sectors in tech continue to outperform, others have not performed well at all. And I think that churn is starting to finalize. And like at the start of these rates going up, I thought we would have a bit more time to see tech kind of complete its rally and catch up with the rest of the market and close that spread. But it's just not like it seems like it's been kind of bound by an upper limit. And when we get to that, everyone just sells it off like crazy. And then we push back up a little bit more, but it's really not gaining the ground I expected it to. Especially with all the increased leverage, right? Which means, leverage is all that increase in leverage is going elsewhere, either to holding up the cost to carry on the long end, or the leverage is going into, commodities and oil, which is possible, right? Because the forward returns on those are significantly better than the projected forward returns for SPX from this point forward. Like earnings yields for next year already got trimmed. They're probably going to get trimmed more during earnings season, right? There's no way we complete this with no landing, right? Um, Despite what you might hear on Twitter. And so, we're starting to get more baked in projections of declining earnings in 2025 and declining GDP in 2025. And I don't think the QRA is particularly important because I don't see any change happening right now in the yield curve control. But if Yellen issues bills again, the Fed won't be able to cut, right? And so, we're gonna end up in a very similar situation to what we were in just 3 months ago before the Fed cut, except with, an even less restrictive rate.
I mean, short-term yields are going to be a lot lower, right? So this is the weird thing. The Fed just sits here and does nothing and lets inflation go up because fucking government can't stop spending money. Uh, we're just going to see the yield curve run invert on the long end.
Mm.
Like pretty much, it's just plain and simple. It's already pretty much doing it. It's just really it's the belly of the curve that's being resistant because there's people who do believe that the base whatever real rate is going to be 3% or whatever it is, or the Fed target rate's going to be 3% or 2%. Sorry, so they're just really hanging on to that. But I think Kashkari is right. That a real rate around 3% is more appropriate than a real rate around 2%. If we're going to have a federal government doing what it's doing right now, there's no world in which we can get back down to 2% that doesn't cause prices to just skyrocket unless we concede that our inflation target is more close to like 3% than it is 2%.
I mean, we could, but we would need to have actually increased rates to a restrictive level and forced a recession, which is exactly what we've tried to avoid. But in avoiding that, we're, amplifying, or at least increasing the potential for the long term Fed fund rate to be at 3%.
Yeah, I think that's ultimately if inflation stays high and the Fed does nothing, the bond market's going to sort it out by raising rates on the long end.
Yeah.
And it's a weird place. I think that in the process of doing that, we're going to see credit conditions tighten a lot, right? Because the prices of durables are going to go up, and wages I don't think are going to keep up with that move. But
You guys want to noodle on something cool that's kind of popping out of some of my equations that's related
sure,
to rates?
I like that.
Um, so I'm trying to look at all of basically all the flows in the economy, and I've lumped together the flows. So what I'm looking for is what is the rate of change of money held in banks over time, and what are all the components? What are all the rate components that factor into that? And one of them is the treasury flows, right? And we have to keep in mind the flows. And so the balance is whether it's restrictive or not for just treasuries, ignoring all the other outlays and everything. For just treasuries, it is, and it's pretty simple. It's so simple when you think about it. Is the amount of debt times the net or average interest rate. So the debt payment over time that to service the debt that the Treasury issues, which right now is just a little over $1 trillion a year. It just breached that last quarter, I think. $1.1 trillion a year. So probably higher by now. And you have to compare that to the rate at which they're issuing new debt. And then also the rate at which the Fed is buying or selling that debt. And so what you end up with is right now, right, the rate at which the Treasury is issuing debt is just the deficit. So the interest payment minus the deficit is basically how much money the activity of the Treasury is sucking out of the economy, right? So we're issuing like 1.8 or I think something like 1.8 to $2 trillion a year in deficit spending, and we're only issuing 1 trillion in interest payments. So the net flow from that activity, ignoring the Fed's component, is minus $1 trillion. From the from just cash balances minus $1 trillion a year. So that is basically people who are trying to hold if everybody's trying to hold the same allocation in their portfolio of bonds, right? I always want 10% or whatever in my portfolio, or bills, or all of them. It doesn't matter. That's all lumped together here. Doing so over time, right, as in aggregate, will lose the economy, all the actors in the economy $1 trillion a year. Plus, then you have to add on what the Fed is dropping every year, which is what, another trillion?
Yep.
I know they slowed it down. What is it right now?
Still about it. I mean, like what? 900 something billion. They
Okay,
didn't
we'll
slow it down that
call it a
much.
trillion.
Yeah.
So yeah, so 1 trillion in through interest payments, 2 trillion out. So it's or sorry, excuse me, 3 trillion out. So it's a net 2 trillion a year money suck, right, from everybody. The only way to counteract that, and this is something I want to look more into to see how this balance worked out over time, is to raise interest rates, right? Uh, but interest rates have to go up. Well, oh, here's the 900 billion though. That's also NDSs too, right?
Mhm.
So that doesn't count. It has to be just the treasuries. Anyway, the rate has to go up to balance that, right? Because if you want an environment where the debt's not restrictive over time, that doesn't cause a drag over time, the rate has to go up. And you can calculate what that rate should be. And I haven't done it yet, but I'm about to. It's basically like double the current rate. And the current average rate is what, like 3 or 4%? Well, of all the debt. What's the net aggregate rate?
What, for like overnight or?
No. For all of the outstanding, I guess we can calculate it because the current deficit is
Oh, you're
what
just talking about for the government.
the government. Yeah. What's the current debt level?
I mean, you could go and actually pull the auction results, right? And then that would give you your actual, like, your current, basically, debt portfolio of the
Yeah, but
government.
we can come up with an average rate more easily because we know the total debt outstanding 35 point. We'll call it 35.8 trillion.
We'll just say 4% or 4.5%, something
And
like
they
that.
and they well, it's the value is really important because we have to basically double it. So if we just eyeball it, we'll be way off.
All right.
Current interest payment expenditures is like $1 trillion. So the current like average interest rate that the government's paying is 0.028. So we need to double that.
2.8%. Okay.
Yeah, 2.8%. So the average, so to not be a drag on the economy, so for people to be compensated for the bonds that they're buying, the rate would have to be 5.6%.
At which point
Which again,
banks fail because
10-year 6% based on our
unrealized
spending.
losses on hold to maturity assets increase as rates rise. Oh,
But
by
that's where
the
we're
way,
going, right? I
that's
mean,
a fun chart.
as the economy tries to reach a new equilibrium, those rates must rise, right? People aren't going to continue to hold these bonds and essentially see this, net outflow from their portfolio forever, right? And so over time, it's going to trend to that, and then it's not restrictive anymore, right? So that's why a lot of people talk about, the Fed has to move quickly because once the economy adjusts to those changes, then you get those balances, right? I mean, if the interest rate was 5.6 today, and for whatever reason we were all okay with just our debt exploding, I mean, I have to run the rest of it. But at that point, I mean, there's other problems that would crop up. But then the debt would no longer be a drag on the economy.
Hmm.
It would just be a drag on our federal government.
And our
The problem
banks.
is yeah,
The banking system would collapse, but the economy would be great. It's almost like the banking system and the economy are at odds.
Yeah, well, I mean, I think that's the only reason, right, that treasuries have not gone to an average of 5.6%.
Because we're affecting yield curve control.
Yes, yeah,
Yeah.
but the banks are part of that as well, right? They would die if that happened, so they're
Yeah.
not allowing that to happen. So they're willing, basically, they're willing to take a future loss to protect their current hold to maturity losses.
Well, it's okay because all of those hold to maturity losses have fallen so much. Oh wait, here, I'll just
Now,
give you the chart.
they haven't they haven't fallen at all.
I'm aware. Here,
Yeah,
you'll enjoy this.
yeah, it's flat. They
I mean,
haven't fallen
yeah,
at all.
and
Well,
it
and
just
part of this is I think part of this at this point. I mean, I know it's only been 2 years, and if I don't know what their average hold to maturity duration is, but it's
Like
probably got to
almost
be at
10.
least so 10. I mean, you'd think after 20% of time passing that would have meaningfully contracted by some amount. But I think
well,
part of
so
the reason why their hold to maturity is just not really going down is because they're taking future losses
Well,
on
their
the new
losses
bonds
also
that they buy.
expand as rates rise. So
I mean, look,
the aggregate amount of
I get that,
yeah,
but these look. I mean, the data points, even when the rates dropped a lot, right? I mean, these didn't really drop a ton,
that's
right?
because
And
they're
the
not
reason
doing
for that,
anything. They're not doing anything with them. They're just sitting on them.
right? But they should go up in value if rates drop,
Well,
which they
they
did
do a little
recently.
bit, right? Like their unrealized losses decline with the fluctuation in rates, but like the total amount of securities on which they realize losses stays the same relatively.
Yeah,
They've rolled off
yeah,
some of their like the available for sale shit, right? And like the treasuries helped with that with their like liquidity program that they instituted back in Q2. And
yeah,
that
yeah.
kind of accelerates the rate at which they can roll them off, but we still need to go from low rates to high rates like 6 or 7 more times for them to actually roll off all of these losses.
So
Oh,
that's the
and
problem. They're the
deposits are
reason,
declining again because people are
right?
going broke.
Yes, yeah.
And
Deposits are no. I don't know if I buy that they're that they're
okay,
going
well,
broke.
not going
It could be
well.
because they're moving to
New
investment
houses.
accounts. No,
I mean,
investment
oh,
accounts.
back into money markets.
You can't store money in a house. You can't store money in stocks.
No. I
It's got
meant
to
the
go
cost
somewhere.
of moving, not the storage of the money.
I get that, but if consumers are pulling money out of the banks, where's it going?
That's I. Hmm.
Are they spending
so
it?
Yeah.
In which
so
Well,
case,
Dirk,
it would go to businesses who put the money right back in the bank.
in August, yes, and then not so much in September.
Yeah. So if you look at like, I think we talked about this a week or two ago. If you look at J.P. Morgan Chase earnings, they showed they had significant outflows of like 9% from consumer year over
Hmm.
year. Um, but they had in consumer and investment, they had a growth of like 8 or 9%. Right. So it's either going to businesses or it's going to investment accounts or both.
I could see money
so
flowing back into money markets as rates rise on the front end again, um,
yeah.
which is good for the short paper. And we're also not seeing any like activity in repo. So I mean, it's unlikely that we're gonna see too much. Like I think everyone's just net short the short end right now, and that's gonna keep money out of repo and keep liquidity in equities. But if rates at the front end start to fall, right? Like say Yellen moves issuance just a little away from the 4.8, right? And more out into like the 42 day or the 3.6. you're going to start to see a lot more money go into repo because, I mean, right now money should be going into repo, except they want the same as cash leverage, right? Because repo rates are drastically higher than rates at the front end of the curve. That's like, I mean, in some places almost 1%, right?
Yeah.
So I put a chart, or I just took your chart and I put some doodles on it.
Nope.
So I just wanted to point out the 3 bars where there was bills passed to dump money on people en masse.
Mm-hmm.
Just to kind of give you an idea of the relative locations. And, you know, one thing we have to kind of, consider, right, is that in 2020, rates went to zero, right? Everyone made profit, right? Everyone made profit. Everyone's bond portfolio went up. So that's why you see like that doink up, right? And then you see it flatten out as the first round of stimulus goes out and just dumping money everywhere, right? To make sure that, we don't enter a depression. You see those profits really flatten out there. And then, inflation starts to pick up. And so that's why you see that big drop in their profits. And at the same time, you see giant piles of more stimulus coming in. And when that stimulus comes in, right, first thing that happens is you get money injected directly into normal people's bank accounts. And what do banks do with that money? They buy treasuries with it, right? But then you also have zero rates, people buying homes like crazy, right? So when you go to underwrite a loan as a bank, what happens there is you essentially are short you're short like a 30-year in a way, right? A 30-year, but with I guess you're actually more like short a 10-year,
Yeah, they're short the 10.
right? So this all sort of plays into this idea that the government spending, right? This is a pretty good illustration of how that government spending has been sloughed off into the banking industry as that money gets fed into the various economic stimuli that were, poked and prodded and fingered over the last 4 years.
It's going
And
towards rent, you disconnected snobs.
I mean, yeah, it was, but I mean, it ended up in bank accounts and ended up in the stock market, right? But a
Yeah.
lot
No,
of
money doesn't end up in the stock market. I'm going to
okay,
drive this
fine,
point home until everybody gets
okay,
it
fine.
beaten into
So
their
someone
head.
gets a stimulus check and buys game stonk with it. Anyways, uh, so in any case, though, the biggest thing, right, is people levered up. They levered up hard, and
Yep.
that forced banks into some sort of weird fucking like bond market diagonal spread. And this is essentially the profile of that. So it's just interesting, but that's essentially how the government sort of set up banks for a very very risky position, and they have very few tools at their disposal to prevent that from happening due to how much regulation goes into their positioning relative
Let's
to
remember
their
that they
their
bought all of
liabilities.
these bonds. All of that free money came in here when real rates on the 10-year were between 0.33 and
Yeah,
1.97%.
yeah, exactly. Yeah, that's exactly right. Yeah, like
And a
imagine
lot of
buying.
it down here at 0.33.
Like imagine buying like a debit spread on the percent yield, right? Not like on the actual bond, but on the percent yield. Like imagine buying a huge diagonal spread to the downside on on this percent graph, right? You can imagine sort of how that would fuck you over if they then tripled or doubled from where you entered those positions.
Yeah. And and this is I mean, I've talked about it a few times, so maybe this will be a simpler way to explain it. I mean, this is why rates are rising when they cut the short end, because Yellen had pushed everything, front loaded the short end. So everybody loaded up on short end,
Yep.
and then that income from the short end is offsetting the flows out to the treasury to buy all the new debt, right? And so higher rates are stimulative, at least in terms of like the bank's balance sheet, because they get more, their net flow is now more positive because of those higher rates. And so when they drop that rate and the deficit isn't in any way meaningfully changed, the only thing that really changes is their net income now drops.
Yep.
And
And that's
so
why
for them to
mortgage rates
try
went
to
up.
survive, yeah. And so for them to try to survive, they need to make up that difference somewhere else, which is the long end of the curve, mortgages, etc. This is only going to get worse as we continue to spend and the Fed continues to drop rates. So um, I actually just think that the Fed dropping rates is going to cause a duration crisis.
I don't think you're wrong. That's why I've been saying I've been harping on that
You're
for
right.
I've been harping on that for a while. Like whenever I say rates will rise regardless of Fed policy, that's pretty much what I'm referring to, is this idea that the long end, right, is no longer in sync because of the environment we have on the fiscal side.
Yeah. Yeah, I agree. I mean, even if the Fed did nothing, the only thing the Fed could do to try to make them whole, honestly, is for Yellen to absolutely just balls to the wall, juice the front end, go all in on the front end, and then the Fed raises rates to like, I don't know, 10%,
Are you basically saying
15%.
they need to reinvert the yield
And
curve like super hard?
the long duration part of the yield curve doesn't go up, it stays low for a long period of time. So we need an extremely inverted yield curve for some number of years, like if depending on how extreme the front end goes up.
Yep.
That could get people out and could get the economy stimulated because the banks are equalized. But yeah, that's also hugely risky.
We're talking
Because
credit card rates going to like 40% annualized or 50% annualized.
yeah, I mean it would I'm just saying what would be good for the banks, right?
Well, that would certainly be good for the banks. You carry a balance month over month and fucking it goes up 10%. You're like, holy shit.
Yeah, so then the in that case, then the credit collapse would be the consumer who can't lobby for wages or spend their way, because spending becomes revenue becomes wages, right? So they basically would have to take out credit to increase their spending because all that money is going to the banks and people who own bonds, which are not poor people. Um, yeah, so if they raise rates on that side, they destroy the economy through unemployment, which is what everybody's talking about, like the Phillips curve or whatever.
Yeah.
I don't think it's a curve. I think it's like a trigger. It's very nonlinear. Um, and if they go the other way, if they go down, they blow up the banks.
Mm-hmm.
But they save the consumer. So and if they stay steady, um, if they stay steady, I would say we get a very prolonged recession as banks slow down, interest rates on things
Rise.
continue to rise and kill things off until we reach a new equilibrium where banks are made whole, and then we kind of have a new lower low that we're running on, or maybe a higher high. I don't know,
Well,
but
no. See what we do. Hold on. You've got this all wrong. I mean, it's all right mechanically, but it's much easier to implement than you think. See what'll happen is as we approach the November Fed meeting, the Fed will start to be really dovish, and rates at the front end will come down, equities will decline, right? And then we'll get to the Fed meeting and they'll do nothing, and then rates will go back up again, and equities will go back up again, and we'll just keep
wait,
doing that.
why would them being dovish make the equities go up? You mean hawkish?
Equities go down.
Or
dovish,
Yeah,
equities
that's what I
down.
mean.
Yeah, because
Why
the yield
equities down
curve's
there?
uninverted now. So we go the other way.
Yeah.
Because the long end rises.
Mm-hmm. Yeah, when the
Oh,
long
that's
end
what-
rises, their spreads move apart.
Yeah.
Yeah, they have more leverage,
Yeah.
so they can pump more leverage into equities and push dispersion. And then when the long end falls, well, more importantly, the short end falls, then they have to sell. They have to risk off.
Yep.
Yep, because the new paradigm is now borrow short,
and
lend
then
long.
roll the profits into long bonds and average up their net loss, or average down their net loss, right? So every time we get this effective crash in the 10-year, they're able to roll off a tiny bit of those unrealized losses.
Very tiny, yeah.
Yeah. Well, that's because they don't really have good control in equities, right? They can't sell off as much as they need to in order to effectively roll. Like if banks had it their way, the S&P would be going from like 5,900 to like 4,400 and then back to 5,900. Right?
Yep.
They really need to make like 5% on every one of those cycles. And anything less than 5%, which we've seen after the last few corrections, kind of tightens conditions a little bit more and a little bit more. And so because, we got a really good like 10% correction in August, but the correction in September wasn't enough, right? And so, now we're at the top and we're like running into like that like kind of excessive illiquidity much faster. And so the speed of these cycles will pick up because more and more participants are going to be pushing the tails, right? And so that's gonna like normalize the distribution and create greater risk on the outer bounds as they continue to attempt this trade until it blows up.
Yeah, it's a really weird. Yeah, it's like the banks, if they could, yeah, you're right. If they could have it their way, we'd have a flat market, but and like the mother of all chop. But but the thing is we've got a huge investor class that is full degen right now.
Yeah, and you have CTAs pushing, right?
Full
Which I
degen.
mean, they like that because they can sell off all of their equity into that positive support. But it also means there's like too many dip buyers and not enough fear when they want to roll that money into long bonds, right? So they're doing great on the equity side, but their returns on the bond side are really shitty. Because if we go to like the 10-year value, like if we go look at the 10-year US 10-year value, right? There's no net positive improvement on this over the last fucking 4 years. Like it's upper bound, is the same. Like it doesn't really go above like, 105. I think one time we hit 106, but like the lower range, like how cheap they get, is decreasing, right? And so their ability, from like October of 2022 till now, their ability to roll over into cheaper bonds is diminishing because the value of the bonds just keeps holding steady. And like eventually that'll just flatline, right? It'll just keep, and there's no more rolling over at that point.
Yep, you got to hunker down and mitigate your risk elsewhere. Yeah, it's a very interesting dynamic. But like, okay, so what does this all mean for the stonk market, though, Girk?
Oh, like on the short term?
Yeah.
I don't know. Can we really push any higher? I mean, I guess Gamma Max moved up a little.
Whoa. We need to. I'm trying to get more viewers in here, Girk. We need to be more
Oh,
bombastic than that.
I'm
Going up.
sorry. SPX
Don't
10,000.
go up.
That is the entire purpose of the SPX, is to go up. I mean, it's entirely designed for that. Let's be
Yeah.
honest.
There's
But
money. There's always money flowing in, right? But it doesn't necessarily mean that the like profitability of those positions is going to increase over time, right? Like a lot of that money is going to suffer just a loss. Like
wait,
there's no value being gained on the money being put into the market here, right?
wait,
If
let
you're
me
buying
see.
SPX at 5,900, you're not making money for years, decades.
So the current S&P 500 dividend yield, by the way, have you ever seen this chart?
Yes, I
Yeah.
have.
Yeah, I'm just gonna pop it in here so you don't have to look it up, so you can show
Of
the
course you
users.
are. Yeah.
But let's just talk about this for
But
a
you're
sec. If the
forgetting
market doesn't
buybacks,
go
bro.
up, well, yeah, that's what I'm saying. If the market doesn't appreciate at an aggressive rate with the fucking dividend yield where it's at, like, it's just garbage. It's absolute garbage. Like this thing, if you get more than a year of flat markets with this dividend yield, and you're just like fully long equities, you're like losing 4%, 5%. I guess like 3% in opportunity cost versus like a 60/40. And if you're a 60/40 even, right, you're still losing something like 1 to 2% just to opportunity cost of not being long bonds, right? And this is sort of kind of the mentality that the market has as well. And I think that a lot of like more informed people out there are sort of banking on, right? And that's why they're going so long, is that's how they get the same yield that they would get from a bond portfolio, is if there is this rapid appreciation and that they are strongly participating in it.
I just want my 20 years at 10%, and then I can quit, dork.
If we get bonds over 5% and we get into a bear market, dude, it's gonna be fucking screwy.
All the banks are gonna blow up. Ooh, is it time to short JPM?
Nah, maybe. I would say after Christmas, but maybe before
I
Christmas.
mean, how much higher can yields go? The 20 year is already at 4.4. The 10 year is almost at 4.1. If it goes above 4.5, all the regional banks start going boom. If it goes above 5, Wells Fargo and Citibank go boom.
I mean, I think that the long end, just based on what we know about how leveraged these banks are into these treasuries, I mean, they could go really, really high if something bad happens.
Yeah, I mean, it's funny. We still are spending
JPM's
all of our
up
time.
7.83% this month. And Wells Fargo's up 18%. Blackstone's up 10.1 and BlackRock's up 10.4.
Oh my god. Jesus Christ.
So one hawkish Fed meeting, and those are going to retrace like 20%.
I mean, we're still talking about, our monetary issues from the perspective of the Fed, the Treasury, and the issue is the spending. So, because we're all going to vote, except for Girk, who doesn't vote in a few weeks.
That's right.
Everybody vote for
There's no
somebody
point in
else
me
that's
voting.
not currently running.
New York's like 9. It's like going to be blue. It doesn't
Like,
matter.
at this point,
who I vote
who
for.
cares which
Yeah.
party it is? Vote for somebody. If you have an opportunity to vote for somebody who's never been in government before, yeah.
Just write me in.
This would be the election. This would be the election to go for it, I feel.
I want to be written
Hey,
in on
Girk.
the ballots of like 30 states.
Girk, I just came up with a dorks dunk for you.
Dorks dunk.
Yeah,
You're fired. That's it. We're replacing you. Does anybody know Python and want to replace Dork?
check out the stock though, and even better if you go to its options chain.
Little dork Dunkaroony.
Oh yeah, this one's good.
Little Dunkadoo.
Do we have data on this?
I don't think so, but man, it's got a lot of range. This thing has like no options volume, dude. Like it would be useless.
What is this? First Trust?
Yeah, First Trust NASDAQ ETF. Dude, this thing has a lot of range to the downside.
Ooh, that's not bad.
And the options prices, even though we're just seeing the market maker diddle themselves, are reasonable.
Little diddle do.
Yeah, I mean, they only go out to May 25, so I mean, it's not like you can get like, gobsmacking amounts of theta, but I mean, depending on how fucking bearish you are and how near term that is, I mean, you can do something with this.
Can I just short JPM futures on like Eurex?
Buy some fucking CFDs, bro. Fucking go for it. Full bear. I mean, yeah, JPM actually has a ton of range too, now that I'm thinking about it. Like, their stock has appreciated a lot. They're up like, what? Is that like 70%?
I just want to
Since like
short.
beginning of
I just want to
2023
short
or,
all the banks before the Fed is hawkish.
or 2024. I think they're up 70% on the year, dude. No, they're up 30% on the year.
Someone whose rights are at risk, please do vote. State doesn't matter. I refuse to participate in a broken system.
You know how you can
State
participate and
doesn't
make your
matter.
voice
I think
heard?
that isn't that backwards. Isn't it like the farther away that person is from you, the less it matters for your daily life?
If you're
Also, all of
upset
what
with how
rights right now are we fighting about that aren't being determined by the states?
I'm actually voting for ranked choice voting in Nevada this year, so I'm pretty
Ooh,
excited.
cool. I would be excited. I would
We
vote
already
for
have
that.
that here. It sucked. We ended up getting a criminal for a mayor again.
Look, Kirk, if you're upset with how our bipartisan system functions, there's another
Maybe you
way
should vote.
we could make a voice of protest
Yeah,
almost.
revolution, bloody revolution.
No,
That's the
there's a
only thing
there's
I
a there's a
support.
there's a form of civil disobedience that you
Oh,
can perform,
gross,
and it
disgusting.
involves
I don't want to be
not
civilly
voting inside of the
disobedient.
bipartisan party lines, and instead venturing out and showing the world that you will not be controlled by the bipartisan system.
You disgust me.
Yeah, you're disgusting.
It's so funny. It's like, God, yeah, our government sucks, man. It's fucked up. This bipartisan shit's stupid. So vote third party.
Yeah.
Like, whoa,
I'm here. Here's what I'm just so thrilled that you literally can't vote for RFK Jr.
Yeah, you know what? He was my choice, but at the same time, I think I actually no. My
Actually,
girlfriend's
you
mail-in
can. You
ballot.
have to
Yeah,
vote for Trump though.
no, my girlfriend's mail-in ballot actually didn't have my girl Jill on it, so I can't even vote for her in Nevada because I don't think she's on the
Dude,
ballot.
Jill Stein is nuts.
Just
She is, but you know
write
what?
in your own penis.
You can't
Ooh.
write in on the ballot for president.
Lame.
There was one person on there, the libertarian candidate. He's a turd sandwich, but I guess I could go for him. I don't know.
Ooh, Dork, you have competition. Gilgamesh says, I'll do it, but only if you pay me nothing.
You know what, Gilgamesh? You know what?
We're
All I
gonna
have to
need
say to that
a
is fuck
2-year
you.
trial period to see if you can
Yeah,
replace
if
Dork.
you know
We'll
what,
get
if
2 years of
Gilgamesh
free labor out of you.
if Gilgamesh wants to manage my absolutely garbage code base, then I mean he could be my fucking guest. But
Alright. Did we miss anything here? What do you
Nick's
think about
going crazy, but
11:15 bot 5830? Hold on. Weird position question.
oh, Gilgamesh backed out. I'm safe.
30, 65, 65, 5900, November 15.
What is the question?
So, okay, so somebody wants to sell a 5865 put, 5865 call, 5900 call, and buy a 5830 put. So essentially naked to the upside of 5980. I would say that the biggest problem that I see right away is that in the short term, your margin requirements will ramp way the fuck up. If we go over 5872, and your break even doesn't move up that quickly, even into the end of the month. Your break even's at like 5917, So if you can sustain being naked to the upside, then yeah, it's moderately unlikely that we see um, a move above 59.80 is sustainable. But you would still need a pullback under, ideally under 58.30, to cash out of this, because let's say end of October. Yeah, you really want to be under 58.30 for the risk reward to be worthwhile. You could have the credit and long the upside call and eliminate the margin requirements and naked risk. Thirty percent of the credit while still maintaining mostly the same profitability. But you will kind of narrow the range of that profitability into expiration. So you'll really want like November OPEX to be sitting around 58.50, 58.60. But it does eliminate a lot of the margin requirements. I mean, you still have to have 50K and well 35K and 10K to cover the spreads. So 13,000 tied up. But versus having to have portfolio margin on that position, but not bad. It's similar to what I have open right now on the pit side. Bot call 5,900. Oh. My problem would be that it's not really profitable on any move until you get out to like OPEX. Yeah, I feel like vol might be too high for this to be worthwhile. I mean, you make a little bit of money end of month if it's like flat between 56.50 and 59.30, which isn't bad.
I mean, you could hedge upside volatility with like some far dated something funded by the credit, but
I mean, this is
it's
really
not a
low
lot.
risk, but the chances of it hitting are slim.
Yeah.
I would say that by then we should be either above our current range, above 59.22, or back way below 5,800. Max loss is 220 on that, so it's just basically a butterfly. Maybe if it was extended, I would like it more. Like if it was something like that, like a wider. Even that would be better because then you are still a little bit profitable on the downside. It sucks, but it's like 1%. But at least you cover that entire range while only suffering a loss to the upside of X. Or you could go the other way and be bullish on it.
Just have to go and make everything directional, don't you, Greg?
Yep. It's better. Markets move. They don't tend to stagnate for especially that long of a period of time with volatility this high. Although it's trimming.
And just short that contract.
I already am.
Or that position, right? Yeah, just fucking do the opposite of it.
How do I make
Just
10K
sit on that
off
thing.
$880? Slowly.
Right, yeah. So what you do is buy $880 worth of SPY and then sit on your ass for about 45 years.
Yeah.
And there you go.
Or buy the dip on NVIDIA.
Find your next NVIDIA. That's what you got to do.
Oh yeah, just figure out what the next AI will be. It's going to be quantum computing, I think.
No, they
No,
already went
no,
through that.
no.
That already happened.
It's going to happen again because now we need it for AI to be good, right? So we're going to find out AI is bad, right? That'll all cycle back. AI doesn't make money. Oh no, oh shit, we invested in this. But wait, quantum
Well, then
AI.
if that's the case, then shouldn't we be buying Google on the low?
Probably,
Because
but it's not low
Google's
enough.
building quantum computers. Yeah, I know, but like if we go through the
I'll
cycle,
buy Google at $80 when they pay to
that's
build
actually my price
quantum
target too.
computers.
Problem
Yeah.
is, a lot of people are building quantum computers. I don't know who has.
Well, Google's got quantum
You know who
computers
I'm
and
gonna long?
piles of money.
I don't
I'm
know
gonna
who
long
has the
fucking
critical
IBM.
IP.
So Google has a fuck ton of money, Jay Fresh. That's the big kicker with them. Everyone's
Jesus
making them, but
Christ,
Google has
I
tons
Yeah,
of
missed.
but
money.
they're also, if they get broken up, they're not going to have a lot of money to spend on unprofitable things.
Guys, I missed the boat.
Why are they
on
going to get broken
IBM.
up? They're never going to get broken up, dude.
Dude,
Monopolies are good.
Have you been following the court cases? They've been losing.
No.
They've been doing a pretty shitty job in court.
Trying to
Yeah,
prove
I mean,
that
I
they're not a
agree.
giant monopoly owned by the Chinese.
Well, they full ported regulatory capture on AI, which was the big mistake, right? They should have full ported regulatory capture on semiconductors.
I mean, the issues that they're being sued for is search and ads services.
Why is IBM worth
Oh,
so much money?
because they
What
make
is this?
computers.
They don't. They don't do anything. They've done nothing but twiddle their dicks and sit around with their giant pile of cash for the last 30 years.
I mean, that's what I would do.
Yeah,
I'm also
God damn
risk
it.
averse.
I should have bought IBM when it was $120. Now I gotta wait for it to go back to $100 so I can
If
go
it goes
long
back to
quantum
$100,
computing.
it's going lower.
Yeah, I know. Oi, I've waited over 3 years. Wind down. You have not waited 3 years.
The market was down 2 years ago.
Has Popcorn Trader even been in
The
this
market was
Discord for
down
3
2
years?
months ago. The market,
refuse
you
to
know, the
believe it.
best part is the market was down when Popcorn Trader was big short. He just didn't close his puts. I don't remember that. That's convenient.
You know, that's a valid argument in court, so I'm going to allow it.
It is hard to refute his testimony currently. I did that. Fortunately, I didn't do that the last time. I did do that in March of 2022, though, when I was like, "Ooh, I'm gonna short everything. The banks are blowing up."
Popcorn, you will address me as your honor.
Ooh, as deposits decline, doesn't the spread and unrealized losses increase because they're unable to meet depositor demand? And they're forced to mark-to-market securities? So that means if deposits keep declining, more banks are going to have to mark-to-market the long end, which is going to continue to drive the long end up.
And the stock
Okay,
market.
but aren't banks still
Sure, we could pretend that. Capitalized?
bank reserves? Bank reserves.
The banking system is sound and resilient, Jay Fresh.
Yeah, let's see if reserves are declining. Reserves on balance at the Fed. Total reserves of depository institutions. It's down a little bit recently. From like March to now, down about 200 billion. Still sitting around like 3.32.
Yeah. It hasn't really been.
It's down a lot from 4.2.
Well, sure.
Yeah. This is the Fed bleeding off their balance sheet, not at all.
Well,
Nice.
they're bleeding it off more slowly than credit's expanding.
Yeah. But credit's not going to expand anymore, right? Because Yields are gonna go up. Credit
Yeah, we'll
crisis.
see. I mean,
I just want them to rip the treasury market in twain.
yeah, I want to see the federal government get punished for their misdeeds.
That'd be cool. You mean you want to see the U.S.
Mhm.
population get punished for the federal government's misdeeds?
Yeah, well, I mean, it's their fault. They voted those morons in,
That's true.
and that's me too, right?
Punish me harder, daddy.
Yeah, get me good. Take me out back.
All right,
Under
let's talk
everything.
our expectations for this week.
Yeah, let's wrap this up.
Who won? Did I still win?
No, I didn't win. I think you did, yeah.
I still won despite being completely off on the last 2 days of the week.
I don't know. Maybe I won. No, I was not bullish enough, I don't think.
I thought you were super bullish.
Yeah, yours was like
I was up like 100 bips, wasn't I?
You
boom. You
did
won.
you were like,
You're the winner, dork.
Hey, look at that.
JFresh did not win.
no.
Fucking A. All right,
You were
cool.
up,
Does that mean I
you
get
were
to go
up
first?
50 bips. I think at one point you were like, oh my god, Gamma Max. And then you pulled it back again at the end.
I think I was like 100 bips, then I was like, nah, we're gonna go something lower. Because I was
thought retail
unusually
sales
bullish.
would have been worse. So I was betting on retail sales being poopy.
Now we had some hot prints.
Yeah, we did.
Okay.
Can't wait for the inflation.
Well, this week I think we're due for some moderation, purely due to the ascending wedge that I observed on my Weeble chart. So, with that in mind, I think we are only going to. What was the closing price of SPX on Friday?
58.64.
58.64. Okay. So I think that we are, kind of hitting a period of consolidation, which means we're probably only going to go up somewhere like 25 bips, but I want to be a little closer to the average upside, so I'm going to say 30 bips. So closing price 58.81.60.
58.81.
As close as you can get to that. Yeah, that works.
You're getting like 81.78.
Perfect.
Oh no.
There we go. That's my prediction.
Okay. Mr. Fresh.
Dr. Fresh.
Sorry, Dr. Fresh.
Dr. Balls.
Dr. Balls.
It's my favorite part about interacting with people on Twitter.
I try to be so polite about introducing me as Dr. Ginger Balls. So fucking funny.
I do enjoy it. I don't know.
You're looking at the data this week? There's nothing. There's just some data on Thursday.
Come on, J Fresh, be bullish.
I think
to.
we're gonna close at 5,800.
You son of a bitch.
So we're just you're doing a straight line too?
There's no data. What are we gonna like? I mean, I just do straight lines anyways because I'm purely playing the statistics now because I'm cheesing you guys, as they say, those young whippersnapper gamers.
Because it's fun to do.
Yeah.
You know what?
I still think we hit 5,900 at some point too, though. I mean, we're so close.
Well, it's too bad your vote has been cast.
You guys change your shit all the time.
Yeah. It's not too late.
Rules for thee, not for me.
59.10. That's what I want. End of week.
God damn it.
We're gonna hit. I mean, there's no way we're not, right?
I think we close around there and like on one of the days of the week, and then open the next with an immediate rejection. If we do test it, yeah, it's not. It's gonna be right at close.
I mean, I can't imagine what would be at 5,900 that would indicate an immediate rejection that we haven't already blown past way below us.
I just think that people are gonna move into positioning around that price.
I mean, there's not really. What are the earnings this week? We didn't talk at all about earnings, which seems like an oversight.
Earnings don't matter. Are you
It's just
kidding me? The
Tesla,
stock
right?
goes up.
Yeah, it's just Tesla.
Yeah, Tesla's
Some
going to go up
airline-
20%
airlines,
because
UPS,
Elon's a douche.
some government contractors, AT&T. Yeah, nothing super.
Ooh, AT&T.
Yeah,
Can't wait to make more money.
Eric, I just had a realization.
What?
Popcorn Trader, I think I'm getting suspicious that he is actually Elon Musk.
Oh my god.
there's no way.
No, he's too cool.
Elon
I
Musk?
think that Elon Musk, outside of the professional world, is a top tier shit poster anonymously.
Yeah, but probably on like 4chan. That seems more like his.
I mean, maybe, but I have my suspicions. All right, they're fairly reasonable, I think.
All right. Closing price 47.89. Do you guys like mine? Mine's just flat all week.
I like it.
Slightly down end of week.
I mean, I think you pretty much hit the nail on the head. Right, we're just so topped out that there has to be some sort of consolidation. But now that I've said that, we're gonna open 150 bips up.
Just open at Gamma Max, straight down from there, right? Like just open here.
I mean,
and then
Bitcoin's
just
been
go like
flat
that
this weekend.
until the end of the quarter, then back to Gamma Max. Or end of the month. So we do that, and then whoop, all in one day. Ew.
It's plausible. Another hot print, and then we're just up 200 bips.
I hate that. Popcorn's funny. Okay, yeah. Theory thrown out. All right, that's the quant
Popcorn
dot plot.
also wouldn't have, based on how much Popcorn chats in the Discord, he wouldn't have enough time to do that and get to level like 150 in Diablo 4.
Well, not only that, he wouldn't have the time to do that and breed with every stewardess on his private jet that he runs into.
There aren't enough horses in the world.
Yeah.
All right.
I don't know. You guys underestimate his autism.
I don't think that helps his focus. Anyway, yeah, so we're good. We got a quant dot plot that looks very unexciting, which means we're gonna go up or down 200 bips this week.
VIX is gonna go to 30. It's gonna be great.
Yeah. And I guess I'll see you guys around. Over the next couple of days. You guys have a lot of one-on-one action to get in with each other.
We've been getting into it. We were in it late last night a little bit.
Ooh. Was it hot?
I'm over here stroking my dick. I got lotion on my dick when I'm just stroking my shit.
Nice.
Does that come through the...
Yes, it does. Yes, it does.
Yeah, so that's what our weekly meetings are like.
Cause there is no cock like horse cock. Send your asshole in. We'll do it live. Fuck it.
Anyway, that's the end of the stream. if you guys have any questions, hit me up on the Discord. And Dork, JFresh, I'll see you guys later.
Thanks for having us.
No problem.
See ya.
Later.